First of all, warm welcome to everyone who could take out time today and come here. And I would like to thank Ajmeraxchange for organizing this beautiful panel discussion with such dignitaries. And I think one topic which is very close to my heart as to how can we use a product, it is a simple product that way, but a product of a portfolio management service to build generational wealth. Now, before I begin, I think a very simple question to the audience would be, how many of you here are not invested in the markets? So I believe the large part of interest has been because most of us here are invested in the markets. And I think another question that I would like to ask is, how many of you would have allocated a certain capital to a professional to manage their capital? So very, very few hands here. So while we would go to lengths to spend on a lot of activities, like say you would spend on an interior designer, lakhs, maybe crores on your house, or maybe for a 5-minute the best physiotherapist in town, you'll spend 5 minutes and you'll pay 5,000. But sometimes to take care of your own wealth, I've seen a lot of resistance when it comes to paying a fees to a professional who can actually help you build generational wealth. And I'm sure over the past 5 years, markets have been in a great frenzy. This has been one of the most fiercest bull markets that we've seen in the last decade or so. And I think it is interesting to understand how we can use PMS as a tool to build generational wealth. So what we'd like to discuss today is, of course, a lot of elements of a portfolio management service, how they are different from a mutual fund and how we could use them, over the next decade or 10 decades. Even, we talk about Amrit Kaal. I think this is a product, and we'll take examples from the US, which is, US and China are only two countries in point where we've seen a country go from a $4 trillion to a $10 trillion economy. So I think the first question to Amisha Ben is that, in 1985, US was at a similar point where India is today. And, the larger wealth managers there, the likes of Fidelity Capital, used to manage $25–30 billion at that point of time. Today, each one of them manages close to $3.5 to $4 trillion individually. So what happened there is, from 1985 to 2000, the AUM grew 10 times. And in the next decade, it grew 10 times more. So we've seen a lot of changes globally in terms of how money has been managed. So before we get into the nitty-gritties and details of a typical PMS product, the challenges and the benefits, I would like to understand from you is, how do you see this panning out in India? And how does a retail investor benefit from it?
So as what you very rightly said, that the assets under management grew 10x and then 10x again over 2 to 3 decades. And again, India is one of the highest saving economy. 29 to 30% of our earnings is in form of savings. But when it comes to putting that savings into physical assets like real estate or gold, to financial assets like FD, bonds or markets, the ratio is still hugely skewed in terms of physical assets. When we come to financial assets, ratio is again hugely skewed in terms of fixed income products compared to equities. So the power of compounding and the ability to grow beyond inflation. What is actually creating wealth? Your savings have to grow higher than inflation. Then only you can generate wealth. Otherwise, every year you lose purchasing power. So that transition is unleashed in India post-COVID. That more and more understanding because of social media, also the time that we as a nation invested because we had no other work to understand what the markets are, gave a trigger, a catalyst to shift from physical fixed income savings to gradually market linked savings. And that's why you see the SIPs rising phenomenally. So this trend has just begun. It's going to grow bigger and bigger. But at the same time, in last 30 years, what happened in US is all these Fidelities and others who are active managers who grew so hugely have become from 95% of market, the active managers, to just about 35% of market, which means another 60% of the money which is being managed is not in the form of active managers. It is by way of ETFs, which means follow the index, as beating the index itself is a tough task. And beyond that, in last 10 years, the biggest trend is do quant-based, which means remove the emotions, play by the rule, use the data, and generate superior alpha. So in last 10 to 15 years, almost 35% of the money is being managed in US by way of quant, 30-35 by way of passive, which is the index funds, and the active managers are 30 to 35%. And I think we will not take another 20 years to achieve these proportions. This will happen very rapidly over the next 1 to 1.5 decades.
Very interesting. When Amisha Ben spoke about this, how much saving basically goes into the financial asset. If Indians are saving close to $1 trillion, I think not even 5% are moving towards financial asset, and the gap is so huge today that I think we need a lot of education on how we can have a large piece of their investments as financial assets rather than real estate and gold, which it traditionally has been. And Amisha Ben spoke about the alpha. Everyone here wants to generate an alpha over, say, the index return. So if, say, Sensex has grown by 12-13% over the past decade, past 2 decades, or past 3 decades, I think everyone wants to beat that alpha by, have an alpha of 5 to 7%. But if you look at the statistics, gold and Sensex over the last 10 years, 20 years, 30 years have given similar returns. Now, of course, I'm not taking making charges, taxes into consideration, then the gold returns fall. But when we are talking about alpha, and this question is to Deven Bhai, that what sets a PMS apart in terms of their framework, and because what happens is everyone is looking at the last 2 years performance, last 3 years performance. Whether you're a rock or you're a rock star depends on how well you've performed over the past 2-3 years, irrespective of I am a long-term investor, but I will invest looking at what is the last 2-3 years performance. So first of all, is it right to compare the PMS return in a very standardized way? And also it is fair to compare a PMS return to a mutual fund product. So if you could just, for the audience, because there's a lot of confusion how to differentiate between a mutual fund product and a PMS product.
Yeah, thanks Piyush for having this question. In a very simple term, if I may have to explain this part, those who use public transport, you can compare them with mutual fund. Those who use their own car, you can compare them with the PMS and EIF. What it means is, mutual fund as a product is a product for common use. In your own vehicle, you have moving destination to destination with ease, I think with whatever ease that you ask for. Whereas in public transport, I think it is governed by the common objective. Nothing wrong with mutual fund as a product per se. However, once you acquire wealth, in the due course of time, you would like to see more personalized attention to your wealth. You would not like, I think, the attention of your wealth being given in a commonized manner. So that makes the difference between the two. Why you require personalized attention to your wealth? look at the numbers. 10 years before, market capitalization was somewhere around $2 trillion. 10 years after, we are $5.5 trillion. 10 years from now, we are likely to be $12 trillion. So in a 20 years time, the size of your wealth is increasing from $2 trillion to $12 trillion, which is 6 times. Now, when this size increases, at such point of time, I think you also require the expertise to manage not only the return, but the risk. Because larger the size, larger the risk. And at that point of time, the need for the professionals would come in. So if this understanding is clear, I think most of the issues get clear here as well. Unfortunately, in our country, when we look at the PMS product, even the regulator treats PMS product as a scheme. According to me, I think the PMS product cannot be called as a scheme. Why? Because every individual's requirement is different. And if an individual's requirement is different, like suppose if I have traveled from suburbs to this place, vis-a-vis somebody traveled from midtown to this place, individual's requirement is different. Similarly, in PMS, I think you can customize the requirement of individual, whereas in mutual fund you cannot. So it is unfair to compare it as a scheme, but unfortunately the regulations also compare it as a scheme. And that's where probably I think this confusion is continuing. In my viewpoint, I think the customization is the requirement. In whichever forum, wherever it is possible, I think we represent this particular subject to the regulator also. And like they have introduced a new asset class, I think they may probably understand this differentiation at some point of time. Will make necessary change, I believe.
Thank you. So I think the differences between you going to a shop to get your kurta stitched is a PMS product, while you going to a store where there are 100 kurtas of similar designs and you're buying it, that is a mutual fund product. So, again, the differences between being an entrepreneur or having a corporate job. So, I think next question is for Shailendra Bhai. I mentioned that, we in 1985, US was where India is today. And, the retail participation at that point of time in US was close to 5%, which is where we are close to. And when they moved from $4 trillion to $10 trillion, this retail participation moved from 5% to 50% by 2000, early 2000. So while there's a lot of worry when we look at market valuation, market overvaluation, a lot of people believing, that a lot of retail investors have come in and they have made too quick a buck, and this is not sustainable, and we are overexposed to the markets. But when we look at case in point to countries like US, which is a direct comparison, it feels that it's just a small speck when we are comparing a larger picture. So what I would want to know from you is that while you're looking at this product, how you should basically evaluate, not looking at the frenzy that has happened or the kind of retail participation that we've seen, but what should we actually consider while we are investing in a PMS product?
Sure, Piyush bhai. First of all, what Dhruv said in the opening remark, and Amisha also said, and you also say, right, the kind of percentage which is there in the market, whether PMS or mutual fund, AIF, it doesn't matter, it's pretty small. It has to grow, right? Why this worry in the mind, you said about valuation and all is like that. Last 2 years, market has not given any correction more than 12-13%, right? Which is a statistical anomaly. So all of us who are in the market for say 20-30 years, in our history it has never happened. So we feel market is very bahut mehenga, right? Look at valuation. Nifty is not trading too high, right? There are some pocket of overvaluation which they keep correcting here and there, correct? Now, in terms of just the appetite, the lever which will take it to 5 to 15, 20%, right? We had a huge amount of real estate and other financial product, real estate particularly, gold maybe. Look at last 25 years, right? Nifty today is around 25,000. Nifty back 25 years back means 1999. It was around 1,000 levels. So the last 25 years, Nifty has gone 25x. If you add bit of a dividend, it is 33, 34 times, right? Look at any other asset class. The gold from 99 to now is around 13 times only. 33 and 13. If you do a real estate, if you take a RBI average pan India, it's like 12, 13 times. So vis-a-vis 12, 13 time of real estate and gold, equity has given 33 times in last 25 years, right? And we can debate, but there is no reason why next 25 will be any different. It's a very simple thumb rule. What I have realized basically meeting, in this journey of wealth creation in India, a lot of IPOs are coming, a lot of new founders are coming, they are becoming billionaire, $1 billion market cap and all. Their CXO become very, very rich, and these guys also become very, very rich. So very new fertile asset class entry is happening on a continuous basis. So unlike us who are old-time market timers, worried about valuations, they are just waiting for any correction if it happens so. Because lot of people among us tell them market is like, valuations are high, wait for some time. So they are also waiting. My own belief is if something goes wrong in the world, they will be the most happy guy because they are waiting with the money to put inside the market, right? So this traction has to happen, What they have to choose, first they have to choose the allocation right. From real estate and gold to equity, that's the first thing to take decision, right? 13 time real estate, 13 time gold, 35 time equity. So if you buy Nifty itself, you make 35x. So first thing is getting allocation right. For majority of the HNI ultra, I deal with the HNI ultra, HNI and institutional kind, not the retail too many. So first of all, they are like very wrongly skewed in terms of their allocations, which I think every one of them have realized the allocations were wrong with real estate and gold, and they're now trying to move more and more about the equity. Barring say 100,000 people in India, mostly in Bombay, Gujarat, some places. Otherwise, India is not exposed to equity too much, right? But there are money people across. So I see a lot of appetite in there. How they choose, first they have to come to market, right? May not be through a PMS or AIF or a mutual fund, maybe direct equity, that's fine. But the idea is to get into. Secondly, coming to the PMS debate, how to choose it now. See, for each of us, taste is different, right? We all like different foods, we all like different this thing, right? And we can't debate one food is better than other food, right? It's basically your style, your type of it. So you have to pick the fund manager. See, the advantage of PMS is like what? The fund manager is accessible to you. A mutual fund manager typically manages lakhs of portfolio. He can't meet that 1 lakh investors in a year, right? Mutual fund guy will be 1,000, 2,000, 10,000 clients at the max. So he will be accessible more to the clients. So pick a fund manager or pick anyone who is basically your test and his test matches. So if you are too much of a cyclical person, don't go to a guy who is a value investor. It's not about good fund or the bad fund. It's basically what you are and whether the guy whom you have handed over your wealth to manage, are two of you matches together or not. So I think that's really my take.
Thank you. So when we talk about, Deven bhai mentioned about schemes, and you mentioned about, how it is important to, decide with fund managers. So there are, say, more than 270 registered PMS, PMS schemes. And the schemes would be 900 plus. And I think they're managing close to 4 lakh crore of discretionary AUM. And, if you look at the 5-year return, on Nifty would be say close to 21-22% versus these schemes, if you average out, I think the returns would be in the range of 20%. While you look at mid cap and small cap in the same time duration, it would be 28-30%. So is return the only criteria to select a PMS? And for most investors here, when I ask the question, how many people here are actually giving their money professionally to manage professionally, very few hands were raised. So can you give them some advice in terms of just taking, extending what Shailendra bhai said? How do you choose? Is return should be the exact criteria, or how it should match your own personality and character?
So one more statistic before I go into how to choose a portfolio manager. I would say that there are about 1,75,000, if my number suggests right, investors into PMS as compared to 4 crore plus into mutual funds. So in terms of ticket size of 50 lakhs plus to afford into a mutual fund, there is still only a particular section of our population which is reached. But having said that, the growth has been highest in the PMS AUM. Now across this 1,200 PMSs or 400 fund managers, if one has to choose, I think there are 2 ways to look at it. There are qualitative factors and, as what we call it, quantitative factors. 2 fund managers generating same returns say 60% return. How would you compare? You need to see, for generating this 60%, what kind of risk is taken, which means how concentrated is the portfolio, how illiquid or liquid is the portfolio. And these two are very important criteria, because if the returns of 60% in one scheme has come, which is very well balanced portfolio across more names, as compared to out of 25, 2 stocks have done 400%, rest 22 have not contributed much, then this portfolio is very risky compared to the other which gave you distributed returns. Secondly, if in some scheme stocks are having 10-20% concentration as compared to others where the cap is at say 5 to 7%. Once again, the return replication will be very difficult, because every time you will not get the right stock where you are overweight. So these two are very critical to see: the risk of liquidity, risk of concentration. Apart from that, when you see the returns, the better way of seeing returns, as we call it, is rolling returns, which means every time from one date to other, the second date to the other, third date to the other, how is the return? If you see returns in a very 1 year, 3 year, 3 months, 6 months basis, the decision making will not be correct. Lastly, it is also important to see, apart from rolling returns, we call it how volatile is the return, which means in selecting the or generating the returns, how much risk is taken. So there are certain ratios in financial markets that we use called Sharpe ratios and Sortino ratios. It's very important to see what is the amount of risk stroke volatility which is gone in to generate this return. And I think that in this gathering, quite a few of you would be there who would have investable surplus of upwards of 1 crore, but have not tried PMSs. And not because this is a PMS forum, but to use a professional fund manager will be very, very important when we have to navigate the cycles of the market. So to catch the cycle right is very important, because in active funds management, 90% of the fund managers still don't beat the index. So how, with all their knowledge, if they can't, how you will be lucky all the time and you can do your own investments and still generate alpha at the moderate risk? Not possible. So it is very important to take professional help. If the investable surplus is lower than 1-2 crores, of course mutual fund is the best route. If not, I would say PMS is definitely better.
Thank you so much, Amisha Ben. The next question to Deven Bhai. So, last 4-5 years, a lot of money has been made. A lot of investors here would have had a loss-making year. And I think it is very important to understand that a PMS fund manager, is tracking the companies very closely. Every 90 days, companies are declaring results. Every 90 days, there are a lot of trends emerging. Every 90 days, there are a lot of green shoots that could be visible. And it is very difficult for a retail investor to track so many parameters apart from meeting the management, understanding the balance sheets, etc. And while it's good that last 4 years no one has lost any money, and everyone's made money on a hunch or from friendly advice or from stock tips, this cannot go on forever. So as Amisha Ben said, that you need a sound financial partner who can help you navigate that risk. So Deven Bhai, the question to you is, one, of course, if you could explain your strategy that you use in terms of your product, but also what are, while we are talking about the positives and how important a role a fund manager plays, a few shortcomings that, we could overcome, or the shortcomings of the product itself.
You want a long answer to the strategy question or your shorter one?
I think a longer one for the audience, shorter one for me.
Okay. So we are all guided by our experience. And in my study of last almost close to 4 decades, I have analyzed Indian markets in cycles. When I was doing my CA, at that time, India economy opened up. I'm talking about 1984-85 period. Since then, I started tracking the market. So today, as we are in 2024, we are in the 5th, 8th year cycle. I'll explain in a while. 1984 to 1992 first cycle, 1992 to 2000 second cycle, 2000 to 2008 third, 2008 to 2016 fourth, and 2016 to 2024 fifth. What typically we have observed in this particular cyclical study, and this is our guided principle also, in every 8-year cycle, in the middle of that 8-year cycle, somehow the reason comes and market tanks. And I can have answers given starting from 84 to 92 onwards till today. But let us take the last cycle, because for the paucity of time, I think on explanation of this part, 2016 to 2024, we never knew that COVID is going to strike in 2020. COVID struck, and in 2020 market tanked. On one single day, 20% fall. Similar situation happened in 2008, 20% fall. It happened in 2013-14 also. So what I'm trying to basically put across here is that in the mid part of the 8-year cycle, market falls and it tanks. Thereafter it recovers. In first 2 years, the recovery is little sharper, it cools down, and then it peaks in the last part of the year. We are guided by this principle. 2024, at the beginning itself, our verdict was that in this year, the market is expected to peak out. When, we do not know, but we'll watch. It actually traveled in that direction, and today as we are talking, quite possible that we have peaked out. What happens next? We are already entering the 6th cycle as far as my journey is concerned, from 2024 to 2032. Somewhere in these 4 years, from 2024 to 2028, I think the market in the first 2 years of the cycle will be gradually moving, sideways moving. Somewhere I think the time correction will be longer. And somewhere in 2 years after, I think the market would start once again picking up. And in 2028, again, I think that will be a time to cash out. Now, this is a typical subject study that we have done, and we are guided by that. Whether the entire portfolio of stocks behaves like this, answer is no. Our markets is experiencing the rotations of the stocks from time to time. So obviously, if 2024 is a year in which market is peaking out, quite possible that some of the stocks may have picked out earlier, or quite possible that some of the stocks may get picked out little later. And thereafter, it may give you an opportunity to buy at lower levels. So this is a study that we do. What is the advantage? I think I add to what Amisha said a while back about selecting the fund manager. What is the advantage? It helps you in building the conviction as a fund manager. Once your conviction is high, you are in a better position to guide your investor along with. And this is fundamental difference between the fund managers. If I am an investor and if I have to choose a fund manager, I'll first look at the conviction of the person. From which direction I think he is bringing his conviction, that I'll try and understand. I spend a lot of time with that fund manager. If you get that opportunity to spend that time with the fund manager, trust me, investment management is not at all difficult. All you need to do is need to spend some time. The other advantage in this entire process, as I see it as an investor, when you start spending time with the learned person, you also get the advantage of learning some of the tricks which will help you eventually, I think, stay cool in a volatile situation. For example, 2020 COVID situation or any other fall in the market which you saw in previous years. I think it helps you to cool down on your anxiety. That is also equally important. You learn from the experienced person. And that's where your first part of the point, I think, which it reminds me, that's where you end up paying fees to somebody. Because you're learning from somebody, that is why you're paying fees for it. You are not paying fees for generating return. In fact, in last 2 years, none of you should have, I think, paid to any fund manager your fees. Because you yourself manage so much of money. But that's not the case. The case is that you're learning simultaneously to manage with discipline. The last point which I would like to add here is where people make mistake or where people go right. What we do, and I would share that philosophy with you, we target a rate of return. And if you endeavor to achieve that rate of return, for example, I'm putting before you the numbers. With your 100 rupee, if you compound your 100 rupee at the rate of 30%, at the end of the 10th year, it is 1489. Very precisely, I'm giving an answer. 1489 without dividend. That number is almost 100 becomes 1500 at the end of the 10th year. If I can target 30% rate of return, it is possible to achieve. Whether do I get this particular 30% return every quarter, every month, every year? Answer is no. The stock specific return comes over a period of time. And if that return is generated in your portfolio, trust me, out of 10 stocks, even if I think 5 stocks gives you that particular return, your portfolio is very, very healthy. And that's what I think one should endeavor to do. These are some of the practices we follow. And that's where probably I think we get satisfaction of putting the money to work. Thank you.
Thank you so much. So, in a nutshell, if you want to learn, you have to pay a smaller fees to the experts. But if you want to learn yourself, you pay a very, very big fees to the market. Another question to Shailendra ji. We've seen hundreds and thousands of books written on how to buy. Not many on how to allocate or what the exit strategy should be. So while you could of course elaborate a bit on your investing style, but how do you look at risk and how do you look at the exit strategy? Like, do you decide the exit strategy when you enter the stock or do you do it on the way? Because that is something that is the most important aspect according to me, allocation and risk. It's very easy to press the button to buy, but it's very difficult to get out of that position. So please.
See, I'll give you very simple here. You all have heard about the word circle of competence, right? So the way I do practice is basically, something if I don't understand, I don't buy. Whether it will go 10x, 20x, doesn't matter to me. Because you can be lucky in those situations where you're not understanding. We don't buy any metal ever. We never buy any agri commodity because I don't understand those dynamics of supply, demand in agri and metal. So you have to be very, very clear about what you understand. You will never understand anything 100%, right? The world is unpredictable. Future is always unpredictable, right? But in certain area, you will have a higher degree of confidence. They understand somewhat what the future will look like in 5 years, 10 years hence, right? In some cases, you have a wild guess, right? So the idea is stick to your circle of competence, whatever is small it is. It doesn't matter it's small or big, right? But you have to stick to your circle of competence. And the second part is like, which is related to exit as well. Are you buying something where a cyclical development is happening or whether a secular development is happening, right? A lot of time you see company going from say 100 rupees to say 500 rupees. And then maybe after a while comes back to 100 rupees in terms of price or in terms of say cash flow or say in terms of profit. It was making 10 rupee today, tomorrow it makes 30 rupee, stock goes 10x. And then the profit comes back to 10 rupee. Those are classically a cyclical story. Because of some reason, temporarily the margin went up humongously and the company made a lot of profit, right? But look at any other company, I'm not naming a company, where the profit every 5 years has gone up and only. They are secular story. Sometimes they'll grow faster, sometimes they'll grow slower, right? But they'll keep growing, right? Their cash flow today in 2024 will not go back to say cash flow they had in 2019. And many company in India falls in that particular thing. So if you stick to that kind of a company, selling question is relatively lesser challenge for you. If you are buying something where the cash flow will revert to the mean or where the large drawdown in the cash flow will happen, subsequently price also will have a drawdown, right? If you're not avoiding those companies, buying only secular story, where something will grow for 100 or 200, stay at 200 for maybe 2-3 years and then to 400, then you can afford to commit mistake in selling. So you have to be very, very clear. If you are a very smart trader, timer of the market, buy cyclical stock as well. If you are not, please avoid. I am not, I avoid completely. I stick to company where I know for sure it will go up, it will stay there, it will not fall. So idea is not a stock going from X and achieving your Y target, but basically staying at your Y target. If it just went there, touched the Y and came back, you were not right, you were wrong. You just went lucky, right? If it goes to Y and stays in Y, it means you understood well the company. So the idea is to buy secular story that we do. We call it principle of linearity. I mean, long stories. Simple thing is like, it has to have a secular story, right? Number one. Number two, the day you realize, in terms of selling, the day you realize that the premise you had, why this company is a secular story, why this company you think you understand, the day you feel, no, neither of these two exist. I thought the company X, but now I am realizing company is not X. Sell it. Its profit, loss doesn't matter, right? Or you thought this company has a secular story. So 2029, this company will be 5x from here. Or 2034 will be another 5x. The day you realize, no, I have a wrong premise, it's not working, sell it. So it's not about price and loss. Pick a secular. So chances of committing mistake will be less. It will not be zero, it will be less. And the day you realize that I was wrong, I had a wrong thesis on the management or on the business, sell it. Doesn't matter what happens, right? If it is not there, stay with the company. In 10, 20 years, you make the generational wealth which we are looking for.
Thank you. We have close to 100 years of experience between the three panelists, and in spite of all this wisdom, the audience would like to know, जैसे कहते हैं ना हम जब गाड़ी खरीदते हैं कितना देती है, तो what is that one theme that we should invest in as we move towards the $4 to $10 trillion journey over the next decade? I think a common question for all three panelists, one theme that you believe will do extremely well over the coming decade.
Sure, let me.
Yeah.
Okay. So one thing which I can say right now, even if you are a self-driven investor, it can be useful, is what I call this theme world topper. Now what do I mean by what I'm saying world topper? So if you look at the 600 large market cap company across the world, 600 top market cap company in the world, 24 are Indian company. So we got a 4% representation in a market cap table across the world, right? Our market cap is also around, our GDP is also around 3.5% or 4% of the world GDP. World is around $102, $103 trillion. We are 3.7, 3.8. So nearly the same number comes out to be. My understanding with all these, lot many CEOs are Indian. We have the best demography. Majority of the workforce in the world is Indian today. With the digital economy happening, you meet across the banks in Europe and US, mostly you will meet an Indian guy. If you go and meet any of those customers, I meet a lot of pension fund and all. Most of them are Indian basically. Now, my own premise is in the next 1 decade, among the top 600 global company in terms of market cap, 100 will be Indian company. And which means a lot of wealth creation. I'll give you a couple of simple, to simplify the whole premise. The world's largest EPC company, engineering procurement, or a contractor company in a simple language, is an Indian company, right? You know the name, it's a Mumbai-based company. It's the world's largest EPC company in terms of market cap. Look at largest Indian hotel company. Is the 10th largest in the world today. And I don't see any reason why this company will not be 2nd, 3rd or 4th maybe globally. And if the company moves from 10th level across the world to 4th level, there's a huge amount of wealth creation waiting for us. And it's not about large cap or mid cap. Across industry, my understanding is you can take any industry, anything, a table industry. Any industry you can think of, IT or a bank. So the largest bank in India is the 10th largest in the world. And in the top 10 banks in the world, there are 3-4 Chinese banks. Why they are there? Why we are not there, right? It's a very simple premise. Pick any industry, a textile, anything you can think about it. Like an IT, you can think about a plywood, small or large or whatever. Think of where the largest Indian companies or maybe top 2 Indian companies are. Just do some Google and figure out in that particular industry, which are the bigger company in the world, right? be sure these companies out of maybe top 3 of India, one will be among the top 3 of the world. And that will give you a cross-industry opportunity to buy a hotel, a telecom services. Think about it, like India is the largest telecom market in the world. We consume a lot of data, right? But our company is not there in the top 5 in the world. Say 2 years back, the only larger listed company in India in telecom service was 17th in the world. Today it is 10th. And I don't see any reason why AT&T and China Mobile will be among the top 2. Why not the other guy, the Indian guy going there in the top 3 or top 2, right? Which means huge amount of wealth creation. So I'm just, for disclosure, I'm not naming you any company, but any industry that you understand you have a circle of competence, pick the Indian company, figure out where the top 3 of the global players are in terms of market cap, assume the CAGR, you will get that, chances are very, very high.
Deven bhai.
Difficult question.
Company which will surpass this 8-year cycle and enter another cycle with gains.
It's a subject which is very close to my study, my heart these days. Anything which does the disruption will create wealth. The wealth is created out of disruptions. And this is going to be the reality in next 10 years more than any time before. Let me give a little bit more deeper understanding on this subject. Where exactly the disruption is happening? Let's take one example. Industries are today spending between 9 rupees to 12 rupees per unit as a power cost when they consume power through conventional sources. You install your captive power and your cost comes down to 2.5 rupees per unit. You will have green hydrogen soon. You blend that particular green hydrogen along with your captive power. The way it would work, during the daytime when the sunlight is on, you will get the power through your solar panels or wind farms. During the night, using that power which you have stored, will convert into the green hydrogen and use it for the night. Your blended cost might come down to 3.5 to 4 rupees per unit. Now just imagine, I think, what it could create in the world. From 9 to 12 rupees per unit to 3.5 to 4 rupees per unit. Fast forward next 10 years. Which means the steel that you consume, which constitute about 52% of its cost as energy cost, will probably come down to significantly lower number, maybe 1/10, 1/20th kind of number will be there. Refinery similarly, manufacturing process likewise. Power cost coming down and India assuming the status of green hydrogen capital of the world is going to be the biggest disruption. Now think about it, which companies will enjoy maximum out of this particular trade, and you will make money out of it. In fact, I think the stock picking, stock selection will become much easier if you follow this particular path of where exactly money can be saved, where exactly I think money can be made. Similarly, the technology, today we are talking about artificial intelligence. People use artificial intelligence for a variety of activities. Somebody may use it for the purpose of processing their workflow faster. Somebody may use artificial intelligence for generating the business out of it. So technology enabler and technology user, both of them are going to get the maximum advantage under this particular situation. It is still evolving. Keep your eyes and ears open. Which company is implementing artificial intelligence to their advantage of either cost saving or for generating revenue? Moment you read the script in these companies, probably I think you get the best out of it. It is easy today. Corporate disclosures are phenomenally transparent. Whatever you want to understand, it is available in the annual reports, it is available in the transcript of con calls, and it is available to public at large. So, to my mind, 10 years journey from now, you are going to get phenomenal opportunities, and the themes are going to be one and many. you can't pinpoint. I think maybe in one industry itself, I think you will find companies operating differently, and somebody is going to make major amount of wealth for you. So keep this particular objective in mind while looking at the speciality in, I think, the finding out which kind of areas one should be investing in. Thanks.
Thank you so much, Deven bhai. Amisha.
So while we all have our eyes on 2047 and what kind of growth opportunities are there in front of us, equity markets is the only class of asset which is liquid. Every point of time, you immediately on a transparent basis can sell or buy. And the price discovery is a continuous process. And because of which, both fundamentals, geopolitical, sentiment, liquidity, everything gets reflected very quickly on the markets. So the long term is required to continue to stay invested. You can't lose your eye from what is it in the medium term while you want to do stock selection or portfolio allocation. And because of that, the continuous murmur that we keep listening is the market overvalued. So market may not be overvalued if I take 2030 target where probably Nifty can reach 40,000 or 45,000. But is it that in the short term it has run up a bit? Because the last almost 12 quarters, we have seen that companies have been giving numbers ahead of analyst expectations. This is the first quarter where we are seeing that most of the companies where the result season has started, the numbers are either below analyst expectation or matching it. And the commentary from whether it is automobile, consumer, large consumer companies is also very sober. So you can see that the moment that tone has changed and market looks at future. So market has already discounted that we are growing at a 7.5% as an economy. We are going to have an interest rate reduction. We are going to have a 22% earnings growth this year. The moment a sigh of worry comes, there is a correction. And a lot of money is made in last 3 years without keeping a distinction between, why do we say that a Siemens deserves a 70-80 P, no problem? Because the management capability is so strong to innovate product, to go through market cycles of their product evolution, hire the best talent. Now that same 70-80 P, you give it to an SME company or a small cap company. How do you have the same kind of management bandwidth? So when the market tide turns a bit, which we feel that it is in the process, the risk has to be cut. The focus has to come a bit on conserving the gain that you all have made. And in the process, shifting back to quality, shifting back to liquidity, shifting back to low volatility businesses and stocks will always help navigate this phase. So considering some of these things, I feel that 10-year view is very good, but if I have to take a 1-year view or so, then healthcare seems growth as well as defensive. Whether it is diagnostic, once you've been asked to get a test done, there is nothing else that comes into picture. Whether you have any work, whether you have it is costly or you don't have money, diagnostic is a must. Similarly, when you are any medical issue, hospitalization, as the economy grows, your health consciousness improves. So diagnostic, healthcare and pharma, I think, which was because the rest of the segments were growing so much, whether PSUs, defense, railways, were little less owned in the portfolio. And now that 18-20% earnings or 15 to 18% earnings growth will also look sweeter as it is more secular. So I feel that in terms of portfolio allocation, some weightage should go to some of these sectors where the earnings growth are more secured and they are not impacted immediately by the kind of little inflationary outlook that we are seeing or the slowdown that we are witnessing across the sectors. So that will help the portfolio navigate to the long-term goal of huge wealth creation.
Thank you so much, Amina Ben. So as a closing comment, I think even the world's finest warriors or the world's finest archer, which we know as Arjun, needed a Sarthi in Krishna to guide him through the perils of the war and eventually help him succeed. The role experts who manage your portfolio play a similar role. They help you guide through this volatility. They help you guide you through these cycles. And while you may want to learn the tricks of the trade, it will come by experience. But experts will have a much, much larger role to play if you want to have sustainable and consistent wealth creation over the coming decades. Thank you so much, Amisha Ben, Deven Bhai and Shailendra Bhai for taking out time and explaining so beautifully the concepts. And thank you, the audience. A big round of applause for the three of them. Thank you so much.
Thank you to all the dignitaries. What a wonderful session. However, I think we do have questions from the audience. And so maximum 2 questions are allowed. So please feel free and ask. Anyone? Yeah. Can you please have the mic given to sir, please? Out there.
Thank you very much. I have just one question, like nowadays many of the AIF have been started. Instead of PMS, they are winding up PMS and AIF. So how it is going to affect PMS services, and on a retail part, how it will benefit us?
So first is PMS has 50 lakhs and AIF has 1 crore as the ticket size. And the tax rules are slightly different in both. As in PMS, the transaction happens in your own DP, so you pay the tax, while AIF is a pass-through. But having said that, it finally boils down to ticket size and the strategy that you want to back. That is the distinction.
Yeah. In PMS, you own the stock. In AIF, you own the unit. That is the distinction. So, if you are interested in owning the stock, learning the company, PMS is the way to go. If you want to remain passive, make your fund manager do the decision making and help you out with it. AIF is equally good.
AIF is similar to a mutual fund. Mutual fund is a retail product. You can buy 1,000 rupee buck also, right? AIF is a 1 CR plus. But again, a homogeneous portfolio is a scheme wise, correct? You can have a large corpus with some unlisted company also becoming part of AIF, not in a mutual fund, right? In PMS is different. Better to say PMS is PPMS. It's a personalized portfolio management services. It's not like a typical scheme. So inside one scheme, even in our case, the 2 different clients could have a very different portfolio, very different level of cash depending upon the client's own requirement, right? So PMS, AIF, it's not a versus between the two. They're 2 different product for a fund manager, the way he looks at the product.
Any other question? All right then. Thank you so much, dignitaries. But you all cannot leave the stage because it's time for a group photograph. Also, I would request Mr. Ashish Ajmera along with Mr. Dhruv Ajmera to please join us for a group photograph.